Now let's talk strategies. Day trading strategies. Six. In this particular session, we're going to talk about only six. There's a lot more. You don't have to trade all of them. You just choose whichever one that fits you most and work on that one until you master it. But let's explain what's the difference between. I can tell you there's a huge confusion about this different strategies, and a lot of people are just jumping between one to another without understanding the difference. We'll start with the first one. First one I was a fan of, a lot of day traders are fan of, and here's why. Fading. Fading, the day trader follows that contrarian mindset, which means you buy the asset that is being heavily sold. So as the let's do here on the board, as the stock is going down, as the stock is selling out like that, you buy. Sell out, you buy. A lot of people call it averaging down. Whatever you call it, that's how you accumulate. As long as you don't put all of your accounts on the first one right here, it works. It works, especially if you're committed to that particular stock or you're somehow familiar with that stock. So you have that contrarian mindset. You buy into asset that's being sold, and you sell into asset that's being completely gone, on a very wild rally. You as a trader, you use that strategy to predict that the herd mentality, the collective market mentality, pushes the prices too far in either direction. So it either goes so high up or goes so high down or so low down to a degree that somebody else, the value money, the hedge funds company, come back and say this particular stock is not worthy of being hammered to that level, and this is a good buying, point. And they jump in. Once they jump in, it changes the fundamentals of the stock, even though, changes the technical side of the stock, because a lot of people will go into argument about which one. Once it changes, everybody else was piling and will push that to a higher level. Second one will be a range trading. Range trading, the trader tries to identify assets that is commonly traded within a set price range. So let's just say the stock goes up, comes down, goes up, comes down, and becomes a resistance and support. So a range trader, so when somebody asks you what kind of trader are you, and you say I'm a range trader, that means you buy in between the support levels and the resistance levels. But you have to understand you have to be very familiar with that particular stock or commodity. So you buy near the low of the range, the support area, and you sell at the resistance area. Range trading requires precise timing, and executing orders in an inaccurate way may result in significant losses. Sudden news or events in the world might change that trend. That trend is not going to last forever. So at some point it's going to break out and it's going to shoot right up. And if you are selling here or you're shorting here and you have a short position and you think it's going to go back to the range and it keeps going against you, you're going for a wild ride. Here's one more thing I wanted to mention. There are such a thing as defending the price, especially in the commodities market. What does that mean to you? Let's just say a manufacturer that manufactures General Electric, for example, they need a lot of copper for their manufacture, or aluminum, whatever metals that they actually use. They will go to the market and they will buy and sell futures contract. As the futures contract continues to drop, they will accumulate their position. They will buy. As goes down, buy. and they keep putting their position here, because what's going to happen is they want to defend the price once it shoots up. Why they don't want it to go over, like, let's say $100, for example? Because at this point, if copper goes over $100, it's going to be a losing business for them. So they want to crash it down. They want the price of the copper to go down, even though they have, like, let's say, million futures contract that is making the money day after day as it goes up. Their manufacturing business is going to start losing money after $100. So as they accumulate in the way down, and then bam, they hammer that market at the resistance level. This way they book their profits from the contract, and in the same time they shock the market and force it down, and the cycle continues. They start buying again, it goes up, and they hammer it, and it goes down again, and it just continues to go. This is called defending the price, especially in the commodities market. Third one, which is, I think, everybody on YouTube, everybody on Facebook, everybody on Instagram talking about scalping and how it made them profitable. Let's see what scalping is. Scalping is a faster version of range trading. Scalping uses technical analysis to buy and sell small price changes to an investment. So let's say the difference between the support and resistance in range trading is like $20. Scalping is using the smaller time frames, which is at least a 5-minute time frame. If you're a new trader, do not go into the 2-minute and 1 minute, because I guarantee you, you're gonna get hammered. You're gonna get chewed up by the losses. So let's just say the 5-minute trading, you go from, instead of that range of $20, you buy here, and you do that risk reward ratio, and this way, let's say if you risk $1, you make $3. You don't wait for the whole $20, because the $20 might take longer, might take all day, might take 6 hours, might take 3 hours. Scalping is like, you open your trade at 9:35 after the first bar is up, and 15 minutes later, after 3 bars up, you booking your profits. Or of course, if you could get stopped as well. So scalping is a lot faster than range trading. It is a form of range trading, but it's a lot faster, and you pretty much try to earn small profits from each tiny movement, and that's what scalpers are. They follow short-term price charts, trying to find these trends. Momentum trading. Momentum trading is another strategy. The difference is momentum. The trend always changes, right? So if the stock loses money one day, it might keep losing money for a few more days until it bottoms out before other people. What happened is, let's just say the market is going fine. It's going fine, and let's say news came up of pharmaceutical company not being approved for the drugs. And what happened is, boom, day one it takes a hit. Now a lot of people, especially those who not have a very close access to the market, they come back in day two and they say, whoa, that went down, so they sell more. And now you got the scalpers and other people, other technical analysis people or technical traders, they continue to shoot it down. And what's going to happen is the market is going to start becoming very narrow as losses every day. Let's say these candles are daily. Every day is going to be a lot less, and then it's going to start going back up again. So momentum trading uses that momentum as a trigger. This is your trigger. So a technical analyst looks at that and say, wow, that is a trigger bar. Let's hit it. And they start, shorten it, shorten it, selling it until it becomes a very narrow range. That's what it is. That's what a wide ranging versus narrow range bars. Narrow range bars indicate the momentum is dying and there is a possible of reversal. Big range bar, which is this huge candlestick, are in fact a trigger. Could be a trigger, could be exhaustion, depends on where they are. If they're in the beginning like this, that's a trigger event that may result in multiple other bars in the same direction, doesn't matter if it's up or down. An exhaustion bar has already been after a long trend, and this is like the people just getting out of it. This is it, they're done with it. And then suddenly the momentum dies, and value traders usually buy here, but they sell the momentum. What else? News trading. I think news trading is pretty common nowadays, or a lot of people, without going into trading, without understanding technical analysis, they actually trade the news. They hear about Apple coming up with a new trade, with a new iPhone, and bam, they buy into it because they think this is it. It's gonna, as soon as it comes out in the market, the price is gonna go up. And that's why sometimes you see the market. Have you ever heard the saying that trade the rumors, sell the news, or buy the rumors, sell the news? So as Apple is about to come with an iPhone, the rumors push the stock market up. It pushes it so high, the news comes, right? And there's no more catalyst anymore. News here, and there's more catalyst. Two things could happen. It could be shoot right up for whatever reason, but a lot of other times it comes, once the news comes, people will start selling the news again, because the catalyst was this one right here, and it's already here, and there's no more catalyst coming. So a lot of people actually trade buy the rumors, sell the news. Number 6 is leverage. Leverage. What is leverage? For you as a retail trader, when you open your margin account with any retail trader, almost 90% of them will give you a 4-to-1 margin. For every dollar you have in cash, they will give you $4 to trade. If you have 10,000, they'll give you 40,000. If you have 25,000, which is a pattern day trader, will give you $100,000. Of course, if you have less than $25,000 in your margin account, you're only allowed to do 3 trades a week, 3-day trades a week, not swing trades. If you have more than $25,000, you can trade in and out every day. Now, some other brokerage, they will give you 8-to-1. Let's just say you put $125,000 into your account. They might raise your margin to 8-to-1 for that. For $125,000, they will give you roughly about $1 million to trade. Not a whole lot of them do it, but it happens. But under certain conditions of income and account. Now, professional traders, licensed traders, they leverage 100-to-1. For every dollar they put in as a risk asset or risk deposit into the brokerage account, they will trade $100. So at $10,000 in your account, which is a small amount in today's market, $10,000 will give you up to $1 million account. Of course, you have to show the brokerage firm that you're responsible, because what happens is if you put all $1 million into one trade and it moves one tick against you, one bar against you, 1% against you, that $10,000 is gone. And as soon as you hit $1,000, most trading firms, most proprietary trading firms will liquidate all your positions immediately without even calling you. Some of them, they try to call you. Most of them, they just liquidate it. It's an automatic. They don't even wait for a person to do it. As soon as you drop to $1,000, they will liquidate it. And it depends, of course, on your account. If you have a $5 million account, because you have $50,000, it could be $5,000, it could be $10,000. So whatever it is, it comes to a point where you have to show them that you're responsible with the money to give you that 100 to 1. If you're not responsible, they will liquidate it. At some time, I used to have 300 to 1 leverage because they don't change it. Let's say you put $10,000, you trade in a $1 million account, and you lose a couple of days, you lose until it gets to $2,000. That $2,000 deposit, they have not changed your $1 million buying power. So that $2,000, you still trade in $1 million account. So you have, at this point, you have a leverage of 500 to 1 that day. Unbelievable. But of course, you have to be licensed. You have to have background check. You have to take the test. You have to pass the test. You have to be licensed and hired by a proprietary trading firm. So that's different from other trading.
Thank you for watching. Share this with friends and family, and please subscribe.